Every great investor, Buffett, Munger, Lynch, Klarman, Lilu, Spear, Pabrai, has reached the same conclusion from very different angles. Long-term stock returns track long-term earnings growth. Over years and decades, the market weighs what a business produces, not what investors guess. Ben Graham's weighing machine metaphor is simply another way of saying that earnings multiplied by time dictate intrinsic value. Buffett stated it bluntly: if a business does well, the stock eventually follows. Peter Lynch summarized the same truth. The price of a stock follows the earnings. If earnings rise consistently, so will the stock. And Munger put a mathematical bow on it. The world is not driven by short-term volatility. It is driven by the long-term compounding of earnings. This report explains why earnings growth sits at the center of all great investment results, and why the long-term performance of the S&P 500 and nearly every exceptional stock can be traced directly to the rise in underlying business earnings. The market price of any business must equal the earnings times the multiple. In the short run, the multiple, which indicates the market's mood, can swing wildly. But in the long run, earnings dominate the equation. Multiples fluctuate around a range. Earnings march in one direction. Over decades, variations in the multiple cancel out, leaving the growth in earnings as the prime driver of returns. This is why Buffett insists that all valuation begins with one question: how much cash will this business produce over its lifetime? Earnings are simply the accounting expression of that future cash. When earnings grow, the intrinsic value of the business grows. When intrinsic value grows, the stock price must follow eventually, because the weighing machine aligns price with economic reality. I want to share some historical evidence for this. For this, we will use the S&P 500 as the ultimate case study. From 1957 to today, the S&P 500's total return has been driven almost perfectly by one factor: the growth of collective earnings. Over long periods, S&P 500 earnings per share have grown between 6% and 7% annually. The index's total return, including dividends, has also averaged 10% to 11% annually. The difference, about 3% to 4%, is simply the dividend yield. The data comes from slick charts. Here is a chart from Bloomberg and S&P Global, which showcases the correlation between price and earnings growth of the S&P 500 index. Put differently, long-term total return approximately earnings growth plus dividend yield. Changes in the valuation multiple have contributed little. Sometimes the multiple expands, like in the 1950s or the 1990s. Sometimes it contracts when there is a lot of fear in the financial system, like the stagflation of the 1970s or the post-dot-com crash of 2000 to 2010. But the data proves it. Over long horizons, the net impact is close to zero. What remains is the steady compound rise in earnings. The S&P 500 is not a narrative-driven portfolio. It is the distilled economic output of America's best companies. Its long-term rise provides the clearest empirical proof that earnings growth is the gravitational center of investing. Let's check the individual winners. What's the earnings growth in action? Every great stock, from Coca-Cola to Apple to Costco, has the same signature: earnings per share rising year after year, decade after decade. Since Buffett began buying Coca-Cola stock in 1988, Coke's earnings have grown more than sixfold. The stock price has risen almost exactly in tandem. Coke's valuation has risen and fallen through market moods, but the long-term trend line of the stock mirrors the climb in earnings. Peter Lynch loved companies like Costco because their earnings were predictable machines. Costco's share price has risen at about 14% annually for decades, almost the exact rate of its EPS growth. Even a company with volatile profits like Amazon shows the rule. In the years when earnings soared, the stock soared. When earnings dipped, the stock paused. Over 25 years, Amazon's price simply followed the arc of expanding cash flows. Across industries and eras, the same law holds. Where earnings go, prices follow. Other than the earnings, a tried and true buffet-style quality investors must have a checklist of all of his key metrics. I have a free cheat sheet with all of the most important metrics which Buffett also uses. Grab your free copy from the pinned comment or down in the description. Why does earnings growth matters more than revenue growth or margins? Revenue, margins, or market share can be misleading if they don't translate into higher earnings. Buffett avoids companies growing by spending $1.10 to make $1. Earnings growth, however, captures several other factors such as the pricing power, cost efficiency, operating leverage, competitive advantages, return on capital. I have separate in-depth videos here on the channel about the 8 types of competitive advantages. I also have a full video about the importance of the return on invested capital and why Buffett and Munger love it. I recommend also for you to check my video on why Warren Buffett does not like dividends and how these companies scamming investors from better returns. Earnings are the distilled truth of a business. Munger noted, it all comes down to the cash the business generates. Earnings are the starting point. When earnings rise consistently, it signals that management is allocating capital intelligently, customers value the product, and competitive advantages are durable. The prolonged earnings allow for the true power of the compounding effect to play out. A stock earning 6% per year doubles every 12 years. A stock earning 12% doubles every 6 years. A stock earning 18% doubles every 4. Earnings growth determines the doubling rate of intrinsic value. Multiple changes may add or subtract a small amount at the beginning or the end, but they cannot alter a 30-year compounding trajectory. Sometimes the market thinks a stock deserves a PE of 8, and sometimes the market thinks the stock deserves a PE of 30. The PE is a reflection of the sentiment, while the earnings growth is the final straw which will break the camel's back, meaning if they are high, the return will follow. If the earnings growth is weak, the return will also be weak. This is why Munger said, the skill in investing is buying businesses that consistently grow their earnings without needing much capital. And why Monish Pabrai observes, if earnings grow at 15% a year and you don't overpay, you simply cannot lose over time. The most underestimated ingredient in investing is patience. The only requirement for benefiting from earnings growth is patience. Lynch advised, the real key to making money in stocks is not to get scared out of them. Investors get scared from volatility, but the true value investors love it. If a stock falls by 50% but its earnings fall only by 20%, this opens a potential for a great buying opportunity as the price has fallen more than the underlying fundamentals. In the short term, the price follows the market emotions, but in the mid to long term, the price follows the fundamentals. Earnings compound slowly at first, then relentlessly, and eventually explosively. Buffett summarized the formula. Time is the friend of the wonderful business. Earnings growth is the engine, time is the fuel, the result is compounding, valuation matters, balance sheets matter, management matters. But earnings growth is the single most important metric in long-term investing because the long-term return of any stock is tethered to the economic performance of the business behind it. Nevertheless, you must not ignore the other Buffett-style fundamental metrics, and I again encourage you to grab your free copy with the most important metrics down in the description. The S&P 500 proves that the earnings growth is the key. Every great stock proves it. Buffett, Munger, Lynch, Pabrai, Guy Spears, Seth Klarman, and many more all teach it. Over short periods, markets are voting machines. Over long periods, they are earnings machines. Where earnings grow, wealth follows. Subscribe for more and don't forget to check out my other videos on the channel.